All right, well, here we go, everyone. Now that we're up and running and live streaming, I want to welcome you to my twice weekly Strategy of the Day update. Every Tuesday, Thursdays, join me here on Facebook, YouTube, or on Twitter to take a look at the markets with me. So, as a reminder, trading involves risk and is not suitable for all investors, and trading futures involves leverage. And offers additional risk on top of that. So with all that being said, nothing I'll say today is a direct trading recommendation. If you have any questions or comments or want to discuss those strategies in detail more with me, I'm happy to do so with you. But everything today is just my opinion and what I'm seeing happen in the market. So let's open the day with kind of where we've been and what we've seen. The last few days in the ag markets have been a little rocky and rolly, depending on where you look. Corn has held on to its strength. We've seen soybeans have been up and down inside of a 10-cent range, and the wheat market continues to press to new highs, which I think today might be confirming or starting to confirm that larger term breakout we started talking about in past videos. In other news, live cattle did rebound well into the end of the day to close positively for the day, with feeders a little weaker but off their lows. We definitely had a rebound in the hog market today, finishing nicely off their low in the Feb lean hogs at 67.87.5. I've got a hunch there might be a bigger bottom forming there, but there's a much larger trading range playing out for the hogs that we've taken a look at in the past. So let's take a look at March 20 corn now. For the third day running, we've got, second day running of higher highs and higher lows after a breakout of our whipsaw reaction from that WASD low. We went down, talked about how we filled the 381 gap fill. We also saw the market trade down and really just test down into and below, run stops really below that 380 area in the market. We didn't make a new low beyond that 371 December low. We didn't puncture the November low at 373 either, but we did carve out a bit of a trading range for corn, snapping all the way back to 390 here today in just a 2-day or 3-day really recovery, 2.5-day recovery. We're starting to press now against larger downward sloping trend lines that have been, in my opinion, offering a little bit of resistance up until this point, right around this 390 area. So if we break through this area, when you set back to this daily chart, there's not much in the way before, after this 392 November high before you get back to $4. And this is something I've been talking about for some time, that 392 has presented itself as resistance. We've been ranging below it for, 2 months now. It's definitely a level to pay attention to from a technical perspective in this market. Again, above 392 opens the door to that $4 area yet again. But beyond there, $4 is nothing more than a psychological level. The prior highs up at 410 are the real level to watch on significant continuation higher. Getting ahead of ourselves because we still have a small time frame trend underway here. 385 ends up being a very interesting level if we see some back and fill price action to pull back. So between 385 to 382, I would expect to see some support if the bulls are going to continue this higher and potentially try to take the market higher. You've got broken trend lines now as support, coupled with various volume indicators like the like this dip here in volume at 386 can typically, when I align with prior highs and lows or congestion levels in the market, suggest areas where the market might come down to quickly trade in reverse from on lower volume, because these bigger volume peaks you see in the market profile are usually formed by a market going up and down many times, or transgressing over that area in price many times, accumulating all that volume. So highs and lows are often found with these where markets taper off, and you can find support and resistance levels that also happen to correlate with those levels. And you can see here how volume tapers off up to 392 because we haven't spent much time above 392. But once we get there again, we would expect to see the market accelerate up into a period of price discovery to find $4 corn or wherever it wants to find its next high. Moving on, a bullish move is starting in the corn, and I expect that to continue here into the near term. Soybeans coming under some fire today with some trade deal headlines coming out from Bloomberg, which is a very interesting place for this headline to come out of. It was the only news agency that reported that today that it was breaking news that we are going to not be rolling back those not sanctions, tariffs on China until after the election. That's actually not surprising at all. That has been the rhetoric since day one. Trump has been very adamant that the phase one deal would not involve additional tariff reductions, and those would be held off till the phase two deal was signed, sealed, and delivered, as that's his bargaining chip. And he has been very, very vocal and saying that phase two will very likely get pushed back until after the election. He wants to use it as a bargaining chip and an election tool as well. So, well, that would be my assumption. But with that being said, today's news headline just was a little bit of a whipsaw in the markets. We didn't see anything other than that headline come out that caused soybeans to sell off about that 7-8 cents down to the lows of the day, or 10 cents off the high to lows of the day. But noticeably, we only ran the stop and ran stops at lows of the day at that time and made a new low. We did not break the prior day low or the day before that, so we now have an inside day for soybeans, which, with this downward sloping trend line across highs, the very visible 940 support area, we seem to be in a congestion zone where if we break above trend lines, get above 950, I think soybeans are primed for their move up to 970, and that would put the March soybean in striking range of being able to take out its contract high there in October, or its highs from October. That 970 area gives way. There's not much in the way back to $10, and lo and behold, we haven't seen a $10 handle in a front-month soybean future since June of 2018. So it is high time, I think, we get a good test at $10. We've got a market that is clearly trying to base above a broken resistance level that we held into the end of the year. We actually have a monthly bullish engulfing reversal pattern happening in the March soybeans, where the month of December actually closed at near highs after making a new low beyond November's low. So it's bullish engulfing to the November candle. January's candle, by actually breaking out into new highs, is a technical confirmation so far that you have a technical breakout higher on a monthly candle for the January beans. This doesn't mean we couldn't trade all the way down to 920 and then find support and carry on, but from a technical perspective, I have yet to ever experience a monthly reversal signal like this in a market. They don't happen often, but it is certainly not something I'm ignoring at this time, because when you take a step back on soybeans, as we've looked at many times in the past, you have this very, very annoying range of $1 from 960 down to about 860, call it 880 here, 80-cent range for the March beans that we've been in since last June. So going above highs, above 970, what does that open the door for the March contract? I mean, to me, it opens the door for new contract highs. There's nothing up here that has traded in March. So I'm very intrigued to see what the March futures do here for the soybeans. And if we can continue this kind of positive energy in the market and get a breakout, there's plenty of fuel for the fire to the upside. If we fail, we lose that accelerant upwards. We start breaking below 940 and certainly below the lows of January at this time at 935. I think it's pretty safe to assume we're going to be heading down towards $9 or 920 to 910, area for a bigger test of a larger support. And really, unfortunately, still be inside of the range between 860 and or 960 and 880 that we've seen for the last 6 months. So it's at that moment where I'm willing to hold my breath for a breakout there for the soybeans, because if it doesn't come, by the time I need to take a breath, it's probably not going to come. So soybeans, or the wheat, March wheat, made a new high here today, breaking out for January, traded to a high of 573. Market held 50% pullback off of its high of 2 days ago, consolidated, and has just continued to step higher inside of a trend channel. This is about as technical as it gets. It's not exactly the prettiest of trends on a day-over-day basis, but it's still marching higher. We still see that series of higher highs, pullback, higher highs made, pullback, higher highs yet again. And then since the start of this year, in fact, that's all we've known for the wheat. So wheat is starting off the year strong. It ended the year fairly strong and stronger than most grains, and it's continuing that march here in the near term. Now, that larger time frame, when you take a step back, you can see, wow, the March contract for wheat and the March contract for soybeans have very similar, bigger daily chart kind of picture, we have this larger range we've been in for basically $1.20 for the wheat. That if we get above 570 here, we are breaking out from last June's highs, July's highs. That we could see the market accelerate and continue to that $6 mark and maybe even above. Above this area, to me, brings into question the market's ability to trade up and to test a new contract high. It's a very big technical range. We're going above it. If a period of price discovery higher ensues, the next major resistance would be that contract high. So it's not there's no serious rocket science going on here, other than markets are finally starting to do what we were all hoping they were. Now it's a question of if we have gumption and the guts to listen, and that's what separates the men from the boys, or the women from the girls in trading. Is that we've spent the last 6 months watching all of this annoyance play out in the market. Now that we're starting to see the first signals of maybe some, what we would refer to as normal type trading or trend trading, environments where markets are moving and we can actually talk about them. We're seeing better trading conditions around almost across the board. Feb hogs. We've got a market that spent the fourth quarter trying to stay up in a range and broke down, but we are still defending the lows of December, November here in January, and defending the contract low at 63.67. Today's reversal was a nice, outside day to the upside, and a reversal candle in that sense. Well, I guess it wasn't outside. We didn't go to a new low. We held yesterday's low and just traded high. But we might have been breaking a short-term trend line here that could take us up in just the range we've been in for a retest towards 72. That's where, if we can push above 72, I think that's where we can start talking about a more longer-term reversal in the lean hogs, because when you look at this 4-hour chart, it's very combatively bearish. And combatively bearish, I mean, because every rally gets beaten back down to test the same support level. Eventually, the support will break, or resistance will give way, and the support will have proven itself as holding. So until that happens, we really can only go off of what the market's been doing inside of this choppy price action for the last several months, and it's really been like the soybeans, of somewhat of a sideways market with a little bearish undertone of fear that China or the big Asian purchase that we're all hoping will come will be there. And then let's see, last but not least, feeders and fats in the cattle had stronger days today, or at least showed some reversal signs in the feeders. Might be trying to bottom here again into coming out of a second test of this low here down in the 145.20 area. Come back up to highs. We just got a range and flagging at highs, holding trendline support, and trying, in my opinion, when you take a step back, trying to break out of that threshold at 147. We break above 147, we clear the way for this market to go, I think, considerably higher. So watching that closely, and that could help if the cattle complex continues holding support where it is and continues busting against its resistance. I mean, markets are speaking here that they're not ready to turn over. Live cattle also just tightening up its range against highs. A longer time frame, we go back a couple weeks, we know the 124.50 to the 127.50 highs is kind of the bigger range. So if we fail below 126, we'll probably revisit 124. But if it continues to hold, we've just got a range at highs. And I'm going to be the type of trader, or I'm the type of trader that likes to assume, or at least objectively look at the market and come at it from my initial perspective of an uptrend like this, is that we're seeing consolidation at highs. Yes, I see that momentum's waning. Yes, I think that there could be a reversal looming, but my assumption is that the market's going to continue higher out of the range the same direction it came into it. Came into this range, went sideways at highs. I'm assuming we're going to continue higher until that assumption is broken. And we've drawn lines in the sand, and we can come up with a few levels where this market may potentially break that trend. 126 short term and open the door to 124. There's a trend line here holding that could come in as support ahead of there, but certainly below 124.50 and the 123.50 lows that we made and started this whole consolidation period back in November. Go below those levels. Now we're talking bigger reversal against a larger trend, where it would be very, very imperative to put on protection or